Last week, we talked compounding interest. You either earn it or pay it. This week, the 3 secrets to a successful high cash value life insurance policy. This is the Life Insurance Financial Education Podcast where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with NetWealth Finance.
The 3 secrets to a successful high cash value life insurance policy. Number 1 that I have on my list here, start early.
Yes, I think that's one of the most important things. And it doesn't necessarily mean that if you're not young, it's too late. Start early can just mean start now. The best time is 20 years ago, and the next best time is now. So whenever that is, it is best that once you discover this concept and get into it, start as soon as possible, learn what you need, and start early.
Yeah, because we're dealing with uninterrupted compounding growth inside of a high cash value life insurance policy, the sooner you start, the bigger it's going to get when we get to the finish line, aka death. So we got to give it as many years to grow and compound as possible. We're not going to be getting out of this world returns. We're not going to get 30, 40, 100% returns in any given year. But there's nothing wrong with a solid financial product that just gets 5 to 6%, even 4% in a tax-deferred environment every single year. You're going to get a lot of money.
Yeah, and I think another thing to consider when we're talking about this start early is it becomes that savings vehicle where you're parking money that gives you these options for doing whatever it is that you need to do. And by virtue of building up some of that cash value, you might arrive at some point in your life where you want to execute on a real estate deal or start a business. By virtue of starting early or as early as you can, you will have built up that bank, that line of credit that you can use to do whatever it is you want to do. So starting sooner is certainly the compound interest that James mentioned is an important factor, but it's also building up to that line of credit to tackle your big deals, whatever you're trying to do.
Well, I like that. Coming at it from the angle of a safe financial product. When you start early, you're building that safe base that allows you to branch out later on in life, take on some more risk, knowing that you have that safe financial base that just in case, you can always fall back on that. You know that it's going to grow and compound every single year, no matter what else is happening in all of your other investments. It's really hard to buy that kind of safety, certainly after the fact. You're always kicking yourself if you didn't get properly prepared.
Yep, absolutely.
All right, number 2. The number 2 key to a successful high cash value life insurance is to optimize that design. Why do you need an optimized design?
I think this is probably one of the things that we talk about most on this podcast because it is so important for various reasons. But one of the big ones in my mind is when you can see cash value in those early years, year 1, high percentage, 70, 80, 90, even maybe slightly even higher sometimes percentage of the dollars that have gone in that year 1. Like that is a really powerful thing as compared to a non-optimized design where you're looking at 0% that you can access. And that's a powerful thing, or it's a deeply damaging thing if you have that $0 accessible in year 1. So I think that's one of the main reasons, in my mind, optimizing is important.
Yeah, emergencies can and will happen. Changes or turbulence inside of your financial life can and will happen. So having the ability to meet those needs in the moment is critically important. I worked with a couple a number of years ago, started a big policy in the first year, which a lot of people are very interested in doing when they learn about high cash value life insurance. They're ready to commit large dollar amounts. Nobody thinks that something bad is going to happen, certainly not in the first year. But when we get near the end of this first year, suddenly they broke up. These people were married for a long time, but suddenly they split. The policy was in her name. She didn't have a job. She didn't have good prospects. She needed to go find a place to live. She was able to cash out that policy. It didn't make sense for her to actually keep it because she had no income coming in since the split. If that had been a poorly designed policy, there would have been no cash value for her to fall back on. But because we designed it the way that we do, she had almost all of the cash available. And that makes you feel really good as a salesperson to know that you put them in a position to succeed. And when we talk about optimized designs, you don't have to have an optimized design in order to have success owning cash value life insurance. You buy an all-base whole life policy, it's going to be very illiquid for a number of years, and then it'll start growing in cash value, and it'll eventually turn into quite a bit of money. Not the best internal rate of return, but it'll be okay. But you have a much higher likelihood of success if we can minimize those expenses and maximize the amount of cash value that that's going to turn into when we can increase that internal rate of return. Not only your enthusiasm to fund the policy, that helps to sustain it, but also just the flexibility that allows may allow you to ride out some turbulent times and have success in a policy that otherwise wouldn't survive.
Yeah, and I think the initial example he gave there is that catastrophic scenario where there's no dollars to fund the policy, and being able to get a high percentage of your dollars that went in back out is powerful. But something you said there right at the end is, well, if you have an optimized design where your minimum payment is somewhere in the range of 10 to 15% of your total annual payment, then you have the flexibility to reduce down what you're funding in a given year. If some slightly turbulent times happen, you can reduce that amount. Obviously, it's better if you fund it higher, but if you need to, you can sort of minimum fund it for a period of time without that risk of lapse, especially if you have put in a couple of strong years. And that sort of connects to that first one. If you have start early, build up that base, you can weather some of these turbulent times much easier. And still, if you need to tap the cash, you can also do that as well.
Yeah, those are really good points. I've modeled out a few designs for people where when we do an optimized design, you might see an internal rate of return of 5.2% or so. But what happens if we run into some trouble for a couple of years and you have to reduce what you're paying in, but then you're able to start putting it back in? You don't get to catch up, but you're able to get back in and start funding it at a high level a couple of years later. And if this happens early on in the policy, what is the effect? Is it going to be a detrimental effect? Turns out, no. You take a little bit of a hit on that long-term internal rate of return, but it's still a very attractive product. We're talking going from 5.2 internal rate of return down to 5.1 over the course of 30 years. That's still a really good product to own, a nice, safe growth product inside of your portfolio that you can rely on. And you were able to just kind of let it ride for a couple of years where you were unable to fund it. But then things picked up, you got your life back in order, and now you're ready to go again.
Yeah, and I think that's the key here. When you have the optimized design, it gives you that flexibility when life happens, because life will happen.
Yeah, and it's funny because we hear a lot of people in this space talk about skinny designs, and they like to criticize the type of designs that we do as if there's more risk in this because you can't maybe put as much money into it over the course of 50 or 60 years as you might be able to do with an all-base design or a design that doesn't include the supplemental term insurance that we do that actually reduces the expenses quite a bit. But on those types of policies, you don't have near the flexibility if you need to cut back. You can't do it. If you can't fund that policy at a high level on the base, your policy goes away. And that's the thing that they neglect. That's where I see the risk in that type of a design, as opposed to the risk of maybe not being able to add a few dollars 40 years down the road into a life insurance policy where realistically, those dollars are going to be a lot less efficient down the road anyways. Not too concerned about that.
Yeah, and I think that, like, realistically, as you're approaching a time frame like that, if you really felt like you wanted to park more money into a whole life or an IUL policy, you can still open these kinda late in life. I've set some people up who have some pretty good policies, and they work just fine if you wanna stuff more money in them. But realistically, at some point, just cutting off the funding to these and relying on what you have in there is just fine, and parking extra dollars in other vehicles, because once you have that solid foundation of these secure assets, these high cash value life insurance products, you can go swing for the fences, put into some risky assets that you might not otherwise have done. And well, that's the other thing too, is some of those folks that you're talking about who are knocking the way that we design, they're sort of like completely anti-market, and that's just not how I think and how you think. I think that's just a different mentality in general.
Yeah, yeah, I totally agree. All right, let's move on to number 3. The third key to a successful high cash value life insurance policy is to max fund it.
Yeah, and I think that we've talked about that number 2, having that flexibility because the optimized design means you don't always have to max fund it. But ideally, if you want the highest success, the best internal rate of return, max funding it is one of those powerful things you can do, because when you get more dollars in there, the ratio of growth to expenses just it shrinks that so much, or that expenses it increases those dollars. You're getting big growth, and the comparative expenses become tiny. And that's one of the things that well, max funding it is really powerful.
Yeah, you don't notice this too much when we're looking at whole life illustrations. But in the case of an IUL, because we can show the expenses, we can show the breakdown in expenses, but even without looking at a policy charges ledger, you can see what the expenses are each year, regardless of the credits. If you have an optimized design and you max fund that, you will likely see an expense ratio well under 1% within a decade. That makes the bar very low for the credits you have to receive inside of the IUL to know that you're going to make money every single year. There are some IULs where we've got a 1% bonus, and if we've got those expenses down at 0.1, 0.2%, you're going to make money every single year regardless of what the market does.
Yeah, that's I mean, I think because you said there that in the first 10 years you can get down to that 1% range, but as time goes on, as you said, it gets into that fraction of 1% and becomes relatively like nothing. A tenth of 1%, and you can have that 1% bonus. You're always going to have some growth in there as long as you don't have giant loans against it, and so it's a really powerful thing that is as long as you max fund it for a number of years, you can these things become money-making machines that become that powerful line of credit for whatever it is that you wanna do.
Let's illustrate this a little bit. I just met with a client this week who has a national life policy that he started almost the same time I started my national life policy. The death benefit for his is $50,000 higher. Now, my death benefit was around $172,000. His death benefit about $50,000 more than that. I funded my policy at $6,000 a year. He's been funding his policy at $2,400 a year. Mine was an optimized blended design. His was not an optimized blended design. I've got now $54,000 inside of mine. Both policies have been in the S&P point to point with a cap since inception. The cash value in his is about $7,000. Massive difference in these two policies that were otherwise the exact same policy, started very close in time together. The return, when I said my average on the S&P point to point with a cap, 7.71, I believe his was 7.72, or vice versa. They were both the same if you went in and looked at it. If you just went in and looked at what did the returns do, you might think, oh, these two policies are going to be very similar in cash value. Not the case at all. Massive difference, and that's because I've been max funding mine. and he was not max funding his.
Yeah, and I think that is a really clear example. Like, when you fund it for that minimum, it's because it sounds to me that amount that he was looking at is probably pretty close to the minimum funding, I'd imagine, for that policy.
It was target premium. He was putting in target premium, which most people, when they just buy a policy from any old insurance agent off the street, they design the policy for target premium. They don't optimize it for max funding. And then the client funds it at target premium, even if that's not anywhere close to the max you can do, what they should be doing in order to sustain that policy long term.
And I think that's one thing where an agent should definitely try to explain that, because target premium is not what you should target funding at. It's more so what is related to those commissions and such. So I think that's where we try to educate on those things. And there's a big difference between that and getting to that max funding rate. He probably could have fit a good chunk more, probably 3-4 times more than he was funding that in that policy. And I think he'd be sitting pretty with the rate of return that he would have had.
Yeah, if he had been max funding it, entirely different situation if we looked at that policy today. I think that means next week, we should actually talk about target premium. Be back for that. Now you know the 3 keys to a successful high cash value policy. Start early, have an optimized design, and max fund it. Appreciate you joining us. I'm James Barber, your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance, and we'll work with life insurance clients across the country as well.
Take care. See you next time.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.